Okay, so now I'm going to begin with our next chapter, that is 1.3, capital and revenue transactions. So the first topic they talks about is capital and revenue expenditures. Okay, so now let's see what is it. There are two kinds of expenditures, that is capital and another one is revenue expenditure. So in capital expenditure, think of it as a long-term investment. You spend money on things that last a while, like machinery or buildings. So these assets aren't for quick resale. They are part of the business, right? Example, buying machinery, constructing a building, or developing a website. They are part of the business. They are not. We are not buying them so that we can sell them easily. No, of course not. We are buying them so that we can use them to generate money for our business, right? So they are a capital expenditure account. So what is the treatment for capital expenditure is we record it as an asset, like a treasure or all. We record it as an asset on the balance sheet. Over time we gradually charge it against profits, like taking small bites. Okay, so that's what we call as what, depreciation. Okay, we'll be gradually charge it against profits. So depreciation is something we are charging against the profit. So we'll be showing it in the balance sheet as an asset itself, and over time what happens, we'll charge it against the profits. Now coming to revenue expenditure, imagine daily expenses, things you pay for regularly like groceries or rent. These expenses keep the business run smoothly, right? So things that we pay for regularly like groceries or rent. Not every business might have their own building. Some businesses, like, they will be renting, right? Renting out. So they have to give rent. So they are revenue expenditures. They are something that makes our business run smoothly without any problem. Example, buying goods for sale. They are very, very important for us, right? Paying salaries or maintaining assets. They all are revenue expenditure. So now if you ask me what is the accounting treatment, yes, we charge it as an expense in the same accounting period. It is completely different from capital expenditure. Capital expenditure, we showed them, if we are going to buy a machinery or something, we'll be showing it in the balance sheet and we'll be taking portions of profits each year. In each, from that year onwards, we'll be taking small bites from the profits as depreciation. Okay, but in revenue expenditure what happens, we'll be recording it in that period itself, accounting period itself. And that's all about capital expenditure and revenue expenditure. Now we are going to see what are the certain rules. There are differentiation of both revenue and capital expenditure. You can go through that. And now we are going to explain certain rules for identification of capital expenditure. Let's see what are the rules. The first one is about purpose of acquisition. If we are going to purchase something and we are intending to use it for a long term, then it is a capital expenditure. So imagine buying things for your business. If it's for a long time use, that means if it is not for resale, quick resale, you can say, if we are going to use it for a long period of time, then it is capital expenditure. Example, a second hand car dealer buying furniture for the office that is being used in the office. He is a car dealer. He is not going to sell that furniture, right? He is going to use that furniture. So for him, this furniture is what, a capital expenditure. But buying cars, let's say if he's going to buy a car, for some other people it will be a capital expenditure, but for him, he is a car seller, he is a car dealer, right? For him, car is a good. So we have already explained that if you are going to buy goods to sell, then that is considered to be a revenue expenditure. Okay, but if he is going to buy a furniture, this car dealer is going to buy a furniture and he is going to use that furniture for his business, then it is a capital expenditure. And the next point is improving assets. Think of fixing up an old house. Spending to improve an existing asset is what? It is capital expenditure. Let's say we want to bring something into we want to put a machine, or we want to put something into work. It is not at all useful at the moment, so we have to make some repairments and all. We have to improve that asset so that we can again start to work with that asset. So when we fix up, and in this example, when we are going to fix up an old house, what happens? We are improving it, right? We are improving an existing asset. That is also a capital expenditure. So if you buy a machine for 5 lakh and add transportation and installation costs, it's all part of the capital expenditure. As I said before, we are already explained in the historical cost concept. We are going to buy a machine that the purchase price is 5 lakh, fine. Its transportation, its installation price, everything will be included in it, right? The original price will be including everything. These things are all part of what? Capital expenditure. So similarly, if you buy a building and add registration and stamp duty expenses, it's all capital expenditure. And the next one is boosting earning capacity. If we are trying to boost, if we are going to enhance the capacity of an asset, and for earning more, then that is called as that spending, the amount which we are going to spend to enhance the capacity of that particular asset so that we could earn more, that will be termed as what? That is also a capital expenditure. Imagine moving your factory to a better location. Any expense that improves your business earning potential is capital expenditure. Any expense, okay? It's like investing in a better stage for your plate enhances the show. Now, preliminary expenses. Picture setting up a new business. Cost incurred before starting that business, like say legal charges will be there. If I'm going to begin, if I'm going to commence a new business, I cannot go and just start a business. It require a lot of procedures before, and it require a lot of cost also. It will incur a lot of cost. So these are what we call as what? Preliminary cost. So preliminary expenses are considered to be a capital expenditure. Okay, these expenses lay the foundation for your business. Only like no one can begin a business just for free of cost. Nowadays, it might be like in digital kind of way, it might be possible, but like it incurs at least something will be incurred as expense. So that will be taken into consideration as preliminary expenses, and this preliminary expenses are considered to be a capital expenditure. Okay, so these are the rules. Now moving forward. Okay. And next topic is deferred revenue expenditure. Imagine paying for something now, but it benefits last over a time. Like heavy advertising before a product launch, when we are going to give advertisement for a product launch, that is actually something that give you a benefit for a over a time, right? We are going to pay it for now and we'll be receiving benefit for it for a period of time. So we'll record a part of it as an expense and other part as an asset. So this is how we treat that. What? Deferred revenue expenditure. Now there is something more to it, that is AS26. We have to discuss the AS26 impact on it. That is, imagine new rules. AS26 changing the concert setup. Now some expenses that were deferred like research or advertising must be treated as regular expenses. Some expenses are there that is actually deferred only, like research advertising, but that should be treated as regular expenses. There are something like that. This AS26 is something regarding that. It's like adjusting the show script. Some things that used to be special are now part of the regular performance. Just like that, there are some exceptions to it. That some situations where it is actually a deferred revenue only, but we have to consider it as what? A regular expense. That is what AS26 is telling. That's all. And our next topic, capital and revenue receipts. Think of it as money coming from special sources, not regular business operations. So capital receipts are those receipts which we receive from those businesses which is not regular. Okay, these receipts don't affect the profit for the year. Example, additional capital from owners, fresh share issuance or selling long-term assets, they all belong to capital receipts. So what is the treatment? We credit this to the capital account and show them in the balance sheet also. After crediting them in the capital account, we have to show capital in the balance sheet, right? So we'll be showing it in the balance sheet. That is what we do with capital receipts. For revenue receipts, what happens? Imagine everyday transactions, money from regular business activities. We are going to imagine that we are going to receive everyday transactions are there, no? They are revenue receipts. So these receipts impact profits. Okay, either increasing, it might increase a profit, it might decrease a profit. So this impact the profit. So these receipts impact the profit. Example, customer payments for gold goods sold on credit. right? I made some credit sales and the customer is paying for it for some time after, or you can say fees for services. So this actually impacts what? Our profit. It impacts our profit. Or you can say when we recover bad debts and all, when fees for services. Okay, so what is the accounting treatment of revenue receipts? We recognize these as income in the income statement. That's all. It is simple as that. Next topic is capital profit and revenue profit. What does it say? Capital profit. Think of it as money from special sources. Just like before only, it is not from regular businesses. The money that we got from special sources. These profits don't affect the profit for the year. Just like capital receipts, this doesn't affect the profit for the year. Example, premium received on issuing shares, profit from selling assets. These are extras, you can say. These are extras that we get from the receipt. So, whatever we get from selling our goods is being termed as receipts. Okay, but the extra that we got, that is being termed as capital profit. So this is actually doesn't affect the profit for the year. Okay, so when we sell asset, we receive amount. We received what? We received some amount. Additional to that amount, we'll receiving some more. That is what we call as what? Profit. And these all belong to capital profit. Okay, and also when we redeem debentures or at a discount, these are all what? Capital. These are all considered to be capital profit. Now for revenue profit, everyday profits is being considered as what? Revenue profit, money from regular business activities. These profits impact the year's profit, just like what we explained in revenue receipts. Example, profit from selling merchandise, providing services or surplus earned by non-profit organization. These are all considered to be what? Revenue profit only. What is its accounting treatment? We distribute revenue profits to business owners or transfer them to reserve accounts. This is what we do. And the final topic of this chapter, capital loss and revenue loss. So what does this say? Think of it as a special loss, not regular business operations. Almost, if you get the thought, if you get the idea of capital and revenue, and every topic is somewhat similar only. The accounting treatment might differ, that's the only difference. But apart from that, the concept are all the same only. These losses, the capital loss doesn't affect the profit for the year. Selling assets is an example, just like we told before. What is its accounting treatment? We either charge it against revenue, like a regular loss, or show it as a fictitious asset in the balance sheet. That's what we do with capital loss. For revenue loss, examples to be given is like giving discounts to customers, bad debts, or other regular business losses. It's all considered to be revenue loss only. So we record these as expenses in the income statement. That's it. Okay, so this is all about chapter 3. That is not chapter 3, 1.3. Section chapter 1, section 1.3 is also over. This is actually very easy things which we already learned before. It's just that I'm explaining so that it's like refreshing your mind. You already know what it is. You can even hear my voice in 2x. But there is a problem because since I'm speaking in English, my English is not up to mark, and I might be using wrong pronunciation as well. So you might be finding it really difficult to cope up with my English, right? My English is, you can criticize it. Of course, I'm not that good. My first language is not English. Okay, so you have to please bear with that. So we are over with section 1.3 also.